It has been a wild week on a number of fronts, but let's highlight some of the issues just recently. Of course, the tale of two retail sales numbers. The U.S. solid, nice revisions. China, not so much. There's a lot of metrics going on with regard to China that have deteriorated, and their equity markets along with it. Divergence, of course, with that and other global weakness have played a bit of havoc in our markets, but let's not dismiss the issue that there have been some credit rumblings at the same time, of course, and somewhat running parallel to the rumblings we're seeing in the equity markets, whether it's leveraged loans or some of the peripheral edges of those types of instruments that central banks so happily built a nice, beautiful new expressway for investors to take upon themselves to pick up these riskier assets. This, of course, is the other side of that mountain. But let's not lose sight of the fact, as jittery as it is, the Treasury complex itself, the sovereign market, has been rather stable, and the dollar index has just been stellar. Look at a one-week chart of the dollar, and keep in mind that as we pursue this risk-off notion, the dollar continues to fare awfully well. And if you open it up to November, we are basically sitting at what is the high for 2018, right, a little bit above 97.5. And that actually goes back towards the summer of 2017 since we last hovered at those levels. Now, on a closing basis, if we were to close above 54 near the highs of the day thus far, that would be the best close since the 20th of June, 2017. When it comes to Treasuries, I was talking to Jim Bianco today, and yes, we've had some periods of catch-up in Treasuries. Think about how that double top of 323 brought us down to our current state of affairs. But all in all, the feedback loop from all other markets to Treasuries has begun. That's probably because the drop had a lot to do with liquidation. Now we hear liquidation to go into money markets. That's selling, maybe pushing yields up. Quickly, let's go to the 10-year board. This chart starts the beginning of 2015. Just through a couple of generic trend lines. We've talked a million times. Double tops are the fuel of sell-offs in yield. This was no exception. We've had a lot of work done at levels we've held. Over the last 10 trading sessions, we've had 3 that basically had lows of intraday lows of 281, even though the low, 282, even though the low close has been 284. You see that we've basically held this line that comes in at 280 along with the congestion. This wedge should continue to help us. But the point of this chart is really simple. Should we do a whole lot of work, meaning a daily close and a weekly close in the same week under 280, that, in my opinion, would be a feedback loop to pay attention to.